Good morning, good afternoon, good evening, wherever you are. My name is Steve Cicchetti, and I'm I'm going to be running the webinar today. Um, and it's a great pleasure for me to participate in the eAccess Forum's webinars, and which I've done now for a number of years. Um, and this is a celebration of the fourth year of our eAccess Forum Prize for Young Researchers. Um, and let me start by thanking the prize committee members, some of whom are here: Stefano Giglio, Galina Hale, Pierre Monin, Marcin Kasperzik, Fernanda Neccio, and Esteban Rossi-Hansberg, who is here for sure. And they all did a terrific job making my life of organizing it pretty simple. We had a large number of really great submissions. We hope to continue that. So any of you, when we do this again next year, any of you have papers, know people who do, please encourage them to submit them. For the first time this year, we have awarded the prize to two papers. The first one is Rebuild or Relocate: Recovery After Natural Disasters by Shifrah Aron-Dine, who will be speaking today. And the second one is Climate Change Adaptation and Sovereign Risk by Sarah Duffy from Oxford University, who will be speaking in January. So today we're happy to have Shifra here, one of the two winners. She is an assistant professor of agricultural and resource economics at the University of California at Berkeley. She's also affiliated member of the Department of Economics there. She studies questions that are related to environmental economics and climate change using tools from macroeconomics and finance, and recently completed her degree at Stanford, so she didn't have to move very far. Um, Although it's very different, having been in these places myself, I will attest to that. I think that we're going to have Esteban is going to give a discussion of this. I will introduce him later, but for now, let me turn this over to Shifra. We're looking forward to your presentation. If people have questions that are clarifying questions, please, well, any questions, please put them in the chat. And if they're clarifying questions, I may interrupt you and ask you to answer them. But otherwise, we're going to leave all the questions until after the discussion, Esteban's presentation. So thank you all for joining us, and we look forward to the presentation. It's all yours.
Great. Thank you so much for the very warm introduction, and thank you so much to the prize committee for this tremendous honor. I'm very excited to present for you today my paper, Rebuild or Relocate: Recovery After Disasters. And based on recent events, I don't think I need to do too much to motivate that this is an important question, sort of thinking about how we design and implement post-disaster policies. This has been a subject of much debate recently in the United States. What do we currently do? Currently, the US federal government policies are focused around this idea of preserving communities, and we spend money to achieve this goal in two ways. We spend money on rebuilding subsidies for homeowners who have property damage, but these subsidies are given ex post and only if households are approved. And the other thing we spend a lot of money on is investing in rebuilding local infrastructure. So in this paper, I evaluate the welfare effects of natural disasters and this policy response. And to accomplish this goal, I'm going to bring together new measurement of the distributional effects of Hurricane Maria, which struck Puerto Rico in 2017, with a quantitative general equilibrium model with migration, housing, and infrastructure. At a high level, what do I find? I find that homeowners with property damage undervalue these rebuilding subsidies. They value each dollar they expect to receive at just 74 cents. Why is that? Well, they're going to potentially lose eligibility for the subsidy in bad states of the world where they have to default on their mortgage or sell their home before completing repairs. Also, there's a lot of uncertainty both about eligibility, so whether or not you can claim this subsidy, and the timing of when you might receive this subsidy. Even if you receive this subsidy, the approval process is very lengthy and repairs take a lot of time. So in essence, what the federal government is currently doing is giving these households a risky non-tradable asset, and we know that makes for poor insurance. Another key finding is that the welfare losses from these types of shocks are large, even for renters and homeowners who don't have direct damage to their properties. For homeowners with direct property damage, it's clear that this is going to lower their housing consumption. It's going to be a shock to their wealth, their home equity. It might lead to higher default risk. But all households in the affected region are going to suffer from worse infrastructure and higher housing costs. Why are housing costs going to go up, right? This is a supply shock to housing. I'm going to find that in this setting, few households can afford to migrate away from the affected region, which is going to mean people are stuck in this market with relatively inelastic local housing demand and totally inelastic supply, at least in the short run. Finally, I'm going to find that alternative policies can yield large welfare improvements at a similar budget cost. In particular, migration subsidies that allow households to leave the affected region, even temporarily, are going to be very cost effective because of spillovers through these housing cost channels. I'm also going to find that unconditional cash transfers that don't tie people to their damaged homes and relax financial constraints, particularly in the aftermath of these shocks, are going to be very effective. So what do I actually do in this paper? I'm studying the setting of Hurricane Maria, which struck Puerto Rico in 2017. A headline number you should have in mind is that over 70% of housing on the island was damaged. I'm going to have some facts about post-disaster behavior from high-frequency flight data and an original survey that I designed and ran in Puerto Rico. The key findings there are that many households migrate, but that high migration costs prevented an even larger number of people from leaving. I'm going to find that most people, in fact, stayed on the island after the hurricane. They had to cope without electricity. Many homeowners defaulted on their mortgage, but in the end, most people were able to repair with this government rebuilding subsidy. Motivated by these findings, I'm going to build a dynamic model of natural disasters with housing, migration, and infrastructure. The key ingredients of the model are heterogeneous households who can either rent or own housing, and if they own, they might own with a long-term defaultable mortgage. Households are going to have the option for temporary and permanent migration, which is going to involve both pecuniary and non-pecuniary costs. And finally, infrastructure is going to be an input both into the firm production and also into the production of housing services. I'm going to quantify the model using my rich microdata, and then use the quantitative model to explore alternative policies, such as an improved screening process, migration subsidies, or cash transfers. So just briefly, how does this paper fit into the literature? There's a large and growing literature on government policy and natural disasters. Here, I'm going to bring new measurement. So for my survey, I'm going to be able to directly link what happened to an individual with the actions they took afterwards. So if your house was damaged, did you migrate? Did you default? Things like that. And with the model, I'm going to be able to study the interaction of policy with rich household heterogeneity, right? Policy right now is mostly focused on homeowners, but of course that's going to have effects through general equilibrium on renters. And so how are they impacted? There's also a long literature in economics on shocks and the spatial distribution of economic activity. Here I'm going to have a direct measure both of the pecuniary and non-pecuniary costs of migration through my survey. And the model is also going to feature a housing friction. So households are going to have to be able to sell their house in order to move to a new location. Finally, there's a literature on mortgages and mortgage default, mostly focused on price movements during the Great Recession. Here, this is a slightly different type of shock, right? It's a physical destruction shock to home equity. Of course, that's going to generate equilibrium price movements, but it's also, interestingly, one of the only settings in the United States where we do large in-kind transfers for home equity losses. So let me jump right in. Puerto Rico, for those of you who don't know, here is this island roughly 1,000 miles off the coast of Florida. It's unincorporated U.S. territory. It's been described by the U.S. Supreme Court as foreign in a domestic sense. But the key features here are that Puerto Ricans are U.S. citizens and they face no legal barriers to migration. So after this shock, they can get on a plane, fly to Miami, get off the plane, and get a job immediately. There's also a very large diaspora population in the mainland US. Hurricane Maria in 2017 was the deadliest US hurricane since 1900. The majority of houses were damaged. There was extensive damage to utilities, roads, schools, all this infrastructure on the island. And this is also a setting where very few households were insured. Fewer than 10% of homeowners were insured for the damage associated with this type of shock. So how am I going to learn about what happens to these people in this shock, after the shock? Well, before the hurricane, there's some initial population in Puerto Rico. I can learn about these people from the Puerto Rican Community Survey. After the hurricane, I can divide people into 3 groups based on the actions they take. There's some group of people who stay in Puerto Rico the whole time after this shock. There's some people who go to the mainland US for a period of time and then come back to Puerto Rico. And then there's some people who go to the mainland US permanently and stay there. So to learn just about the numbers of people that leave either temporarily or permanently, I can use the fact that Puerto Rico is an island and that all travel to the mainland US takes place via commercial air travel. So I can use data from the Bureau of Transportation Statistics. You should think that in this data, I can see at a monthly frequency the universe of passenger flows. So I can see how many people fly between San Juan, Puerto Rico, and Miami, Florida, for example. And at a quarterly frequency, I can see a 10% random sample of all tickets sold. So I can track people then to their final destination. This data is going to let me construct a unique high-frequency measure of migration after this shock. But right, this data is only about aggregate numbers. I can't see anything about who these people are who are taking these flights. So to learn more about why people are taking the actions they took after the shock, I designed and ran this survey of households in Puerto Rico. I did 2 waves in 2023 and 2024 with roughly 1,000 respondents across the 2 waves. You should think that the population of survey respondents is representative of the current Puerto Rican population along dimensions we might think are important, such as English fluency, birthplace, household income, homeownership status. I asked extensively about their experiences after Hurricane Maria. So was your house damaged? Did you migrate? How long did you stay away for? Things like that. I also elicit migration costs, as well as people's perception of the outside option. So what people think they would earn if they moved to the mainland US and how much they would pay additionally in housing costs, in addition to rich demographic wealth and income data. But I want to stress that the sampling frame of my survey is only people who are currently in Puerto Rico. So there is this group that I can't see in my survey, which are people who went to the mainland US and stayed there permanently. I'm going to have to infer who these people were from changes in the Puerto Rican population distribution, basically. You should think I'm looking for missing mass in the population distribution. So what do I find? I find that many households left after this large natural disaster. Here I'm plotting on the x-axis the time since the hurricane made landfall, and the y-axis is net out migration from the island in terms of passengers. So the hurricane happened towards the end of the month of September. You can see there's sustained out migration for several months, and then some people come back to Puerto Rico. Here in orange, now I'm just plotting the cumulative estimate for out migration. So in the short run, I estimate that 7% of the initial population of Puerto Rico left for the mainland US. In the long run, roughly 60% of those stayed in the mainland US and 40% returned to Puerto Rico. I surveyed these migration costs directly. So you should think in my survey, I ask about pecuniary migration costs. How much do you think it would cost for you and your family to move to the mainland US for a few months? Think about plane tickets, temporary housing, stuff like that. I find currently that many households have expected migration costs that exceed their reported liquid asset holdings. So that means that many people today couldn't afford this temporary migration to migrate temporarily to the mainland US. I also ask a retrospective question. Did you want to migrate after this large natural disaster, and were you unable to afford it? And there, 50% of respondents in my survey say that they could not afford desired, even temporary post-Maria migration. All this to say is I think this shows that these pecuniary migration costs are quite important for households in this setting. But right, only 7% left in the short run. So most people are in fact staying in Puerto Rico. Most people are homeowners before the shock. And what I'm going to find is that the damage people experience really drives their decision making. So here in the bar chart, I'm showing you the fraction of homeowners with a given level of damage. So you should think minor damage means you had some cosmetic damage to your house, some shingles, some paint, things like that. Moderate damage is your roof blew off, and severe damage is your roof blew off and you had one other structural component fail. In red, I'm showing you the fraction who had a mortgage at the time, who defaulted on their mortgage. In orange, the fraction who sell before completing repairs. And in blue, the fraction who ever repair by the time I construct my survey. You can see immediately that mortgage default is increasing in the size of the home equity shock, that is the amount of damage that people experience. In aggregate, 5% of those with a mortgage default, but among those with the most severe damage who had a mortgage at the time, over 20% defaulted. I show you that nearly all homeowners eventually repair. Only 6% have not repaired by the time of the last wave of my survey. But somewhat surprisingly, most households report that they're living in their damaged property until repairs are complete. So you should think that they're literally putting a tarp on the roof and continuing to live in the damaged structure until they can get repaired. Most people are reporting government funding to finance repairs. The rest are using their personal savings or borrowing from family or friends. Very few households are insured, and very few households are using bank lending to finance these repairs. The other key feature of this setting is that most households are without reliable electricity for a long period of time after the shock. The median duration without reliable electricity is 6 months. So I've showed you a bunch of facts about what happened after the shock. And now let me sort of summarize and talk about how they're going to inform various features of the model. So I showed you that many households migrated and that high migration costs prevented an even larger number of people leaving. In the model, this is going to motivate having households make a choice whether they want to migrate temporarily or permanently, and also to have pecuniary costs of migration that are going to interact with a borrowing constraint, in addition to having non-pecuniary costs that might influence this decision making. I showed you that mortgage default rates are increasing in property damage. This is going to motivate having an endogenous default decision. So households are going to know that this government policy is in place and that they might get it, and they're going to decide whether they want to try for this policy or default in the short run. We also know that the distribution of mortgage balances, wealth, and housing tenure is driven largely by income dynamics. And so the model is going to feature income dynamics that can endogenously give rise to the distribution of these variables before the shock. Finally, I showed you that with government support, nearly all homeowners eventually repair their house. In the model, this is going to motivate having a choice whether households want to self-finance or apply for assistance, where when they apply, there's going to be some risk of denial. It's also going to introduce this interaction between rebuilding and migration choices. You're going to have to be in Puerto Rico in order to claim this subsidy after the shock, which is going to limit your ability to migrate away when the power is. Okay, so jumping right in now to the model. At a high level, what's going on in this model? Puerto Rico is a small open economy. There's going to be competitive firms that produce with labor, capital, and infrastructure. And this infrastructure is going to be financed by a local output tax. There's going to be construction firms that build capital, all new capital. So they're going to build housing capital, government infrastructure, as well as capital for the firm. But there's going to be time to build in this model, as well as an adjustment cost on investment, which is going to drive some congestion for effects in the construction sector after the shock. Puerto Rican households have faced idiosyncratic productivity shocks. They can save in a liquid asset at some exogenous interest rate. They have this outside option of moving to the mainland US. They can rent from a real estate firm or own housing with a long-term defaultable mortgage contract where they face a loan-to-value constraint at origination. Excuse me. They get utility from housing, from consumption, and from living near other Puerto Ricans, as well as having a bequest motive at the end of their life. The service flow that a household gets from a unit of housing or from a house depends on how big the house is, the quantity, whether or not they're a homeowner, as well as the per capita level of local government infrastructure. So this is a channel by which, even if your house is not directly damaged, your house is going to deliver a lower service flow when the infrastructure stock has been damaged. A natural disaster here is going to be a one-time unanticipated capital destruction shock. So just briefly, how do these decisions work? A household that starts the period as a renter is described by their states, their age, income, and assets. They can decide whether they want to migrate to the mainland US or stay in Puerto Rico. If they migrate, they get no income in the period of migration, but they get this utility. You should think they're like sleeping on a relative's couch for one period. They have to pay their idiosyncratic migration costs from their start of period assets. Then they decide if they want this to be a temporary move or a permanent move. If it's a temporary move, they're back in Puerto Rico next period. If it's a permanent move, they get some outside option of living in the mainland US that comes from solving this exact same problem, but with mainland US prices. If they stay in Puerto Rico, they earn income. They can rent from the set of undamaged homes. They can buy in undamaged homes. When they buy, they choose not only the size of the house they want, but their mortgage balance as well. Owners are described by a richer state space, not only their age, income and assets, but also their outstanding mortgage balance, the size of the house they own, and any fractional damages to their house that they've experienced. They can decide that they want to default on their mortgage. If they default, there's a utility cost, but they retain their non-housing assets, and they're also excluded from buying for 1 year. If they sell their house, they can buy again immediately. They can migrate immediately. They face the same problem as the renter on the last slide. If they don't sell, they have to continue to pay their mortgage, their property taxes, and any maintenance costs on their home. They can migrate to the mainland US, but only temporarily. They can hold on to their house and live in it with any potential damage, or they can decide they want to repair the house. And here it's the same 1 period time to build timing where they pay the contractor now and the house is repaired next period. So how does government policy work in this model? It's going to be transfers for rebuilding infrastructure. It's going to be the features of these rebuilding subsidies. And I want to stress that it's not locally financed. This is a transfer from the rest of the US. Households are going to choose whether they want to apply. There's going to be some probability that if they apply, they are approved. And this is trying to capture the fact that there were a limited number of inspectors who could come and verify the damage to people's homes. And there was also a pretty large documentation hurdle to prove that you were the owner of the home at the time. If approved, households get either the full value of the repairing their home up to this subsidy cap, and the house is repaired next period. If they're denied, they have to live in the damaged homes and they can apply again next period. So equilibrium here is pretty standard. Everyone's optimizing, markets are clearing. The wage in Puerto Rico is going to clear the local labor market in Puerto Rico. House price and rents have to clear the local housing market, and the construction price has to clear the market for new construction. When there's a natural disaster, this one-time unanticipated capital destruction shock, the economy is going to converge to a new steady state. But this model features population size indeterminacy in steady state, which means that the long-run population here is going to depend on the policy response. So depending on the generosity of the federal government transfer, in the long run, there will be fewer or more people in Puerto Rico. Let me just trace through a natural disaster in the model because there's a lot going on. So what are the direct impacts of this shock? Right? The shock destroys a bunch of housing. There's less housing. It also destroys a bunch of infrastructure and firm capital. So there's reduced housing services and reduced output. There's 3 groups of households after the shock. There's homeowners who have direct property damage, homeowners who don't have direct property damage, and renters. And the equilibrium effects of this model are going to work through the prices and through the size of the population, this homophily type term. What happens to rents after this shock? Well, there's less housing, so that's going to put upward pressure on rents. Also, if the bunch of households default on their mortgage, they have to rent for at least one year. And so that's going to put additional pressure on the rental market. Migration here is going to alleviate price pressure in the rental market. What happens to construction costs? Well, there's going to be lots of rebuilding after the shock. If we subsidize rebuilding, that's going to cause costs to rise even more. And that's going to affect the user cost of housing as in equilibrium. So the idea, if you need a plumber to fix your house when there's been this large natural disaster, the plumber could be fixing the school. You're going to have to pay more for the plumber to come to your house. House prices in this model are tied to construction costs and rents. And so if rents and construction costs go up, the value of housing has gone up. And so house prices will rise per unit of housing. This is also going to change the loan to value constraint that households face at origination, and it's going to make it harder to transition to home ownership. So now let me try and briefly put some numbers on the model before we can talk about policy. So in steady state, this is a pretty standard macro housing model. And so I'm just showing you here that the model does a pretty good job of matching that steady state distribution. The steady state distribution of mortgages, homeownership, house values across the age and income distribution. So here I'm showing you in the top 3 panels across the age distribution, the homeownership rate, the fraction of homeowners who own their home without a mortgage, and average house values. And then I'm showing you the same moments across the income distribution. So the key thing here is that older people in Puerto Rico tend to own are very likely to be homeowners, and they own their home outright. The things that are not standard in this model are what happens after this shock. And these parameters are identified from the transition path after the shock. So the 3 things the first thing I need to pin down is the utility in the period of migration. Here I'm targeting the migration response after Hurricane Maria. So I'm showing you here that the model can do a pretty good job of matching both the short run and long run migration response to this shock. But I can also run the model with smaller shocks, so smaller hurricanes that happened in the past, but still in the sample of when I have the flight data. And so that's what I'm showing you here for these 2 much smaller prior hurricanes. The model can do a pretty good job of matching the migration response as well. I have to pin down the utility penalty of default. Here I'm trying to hit the aggregate default rate, and I'm not targeting sort of these default rates by property damage levels. The key here is I'm using the same sampling frame in the model as in the data. So it's only people who are in Puerto Rico when I would have done the survey in the data, in the model moments. The last thing I need to pin down is this congestion force in the construction sector. And here I'm going to target changes in house prices. So you can see in the red triangles, house prices go up quite a bit. I don't have direct data on construction costs and rents. I have from this very nice micro paper, an elasticity of rents with respect to property damage in Puerto Rico. And there, the rental response that I estimate in aggregate roughly matches the micro elasticity that they get. But you should focus here that the path for prices, right, in the period of the hurricane, supply is fixed, and so prices have to move around a lot. And after that, supply constraints are less binding, but there is still this adjustment cost that's going to cause prices to go up. Okay, so hopefully you're on board with the model and that it produces sensible numbers. And so now we can use it as a tool to talk about current and alternative post-disaster policy. So I have sort of 4 experiments that I want to use the model to think about. The first is take the same shock, but don't do any federal transfers. There I'm going to find that absent federal policy, natural disasters result in very large welfare losses. Then put policy in place, and I'm going to show you that it partially mitigates the effect, but that it's not cost effective. And in particular, households really undervalue these rebuilding subsidies. Then I'm going to try to think much more carefully about how migration matters in this setting. I'm going to think about counterfactual economies with higher or lower migration costs. I'm going to show you that migration costs are key to how households can cope with natural disasters. And then finally, I'm going to think about what if we did a budget neutral change to the policy where we just give everyone unconditional cash transfers. I'm going to show you that unsurprisingly, that results in large welfare gains on aggregate, but it's going to have some interesting heterogeneity that I think is going to be helpful for thinking about insurance in these types of settings. Okay. So without any policy in place, this is a very large shock, especially to homeowners with property damage. I estimate this is a 26% consumption equivalent welfare loss. This is a very large number. Why is it so large? Right? It's a large permanent wealth shock. This is on average 50% of households' pre-hurricane net worth that's destroyed. Here, the home equity position of a household is key. If they have very little home equity, they want to default on their mortgage and offload some of the loss onto the lender. If they own their home outright, they have to bear the full loss of this shock. In addition, the damaged housing is going to deliver a lower service flow. So the fact that in Puerto Rico, there were lots of older homeowners who own their home outright is going to drive a lot of this large. I'm going to find that even homeowners without damage also experience very large consumption equivalent welfare losses. You might be concerned prices went up. Why aren't they better off? It's true that the price of their asset went up, house prices went up, but these are paper gains. They have to be a net seller of housing to benefit, and no one can the prices are such that no one can effectively execute that arbitrage. They also face lower wages, higher maintenance costs, and reduced housing services along the recovery path. It's a similar story for renters, but I showed you that rental prices went up even more, and so their losses are slightly higher. What happens when we introduce a current policy? Right? Unsurprisingly, a policy that is designed to help homeowners helps homeowners the most. This subsidy provides an in-kind transfer for their home equity losses. It provides a very strong incentive for households to hold on to their damaged homes. I estimate that without this policy in place, 17% of households would default on their mortgage. With it in place, only 7% default on their mortgage. This also has implications for prices, but sort of unsurprisingly, because of these delays in the approval process, households that are better able to wait out the delays, so wealthier households, less financially constrained households at the time of the shock, are going to benefit the most. Also, when we're doing all of this infrastructure rebuilding, that makes all housing nicer. It's like a TFP shock to private firms in Puerto Rico. There are higher wages, but if we're doing more rebuilding, there's more congestion in the construction sector, which has some implications for housing prices. But overall, I find the current policy package raises the value of staying in Puerto Rico and lowers permanent outmigration. So without the policy in place, 7% of the population would have left permanently. With the policy in place, only 4% leave. How do households value this policy? I want some metric of this value at the individual level to be able to compare to budget cost. So I'm going to solve for the cash transfer, holding prices fixed, that makes a household indifferent between living in the world where the government does nothing, but they get this cash transfer, and the world where a policy is in place. I'm going to find that infrastructure rebuilding is cost effective because of all this complementarity between housing and production. But I'm going to find that even homeowners with property damage undervalue these rebuilding subsidies. This is because the subsidy is structured as a risky, non-transferable asset. They get nothing in the bad state of the world where they default or sell. This makes for poor insurance. The denial of claims also introduces uninsurable policy risk into this setting for households. And when we're doing lots more rebuilding, that raises construction costs. So for each dollar we transfer to households, they get less quantity of house built. What patterns in the data would have led to a higher policy valuation? I would have had to been able to infer that a higher value of staying in Puerto Rico, less mortgage default in the data, stronger homophily preferences, so higher value of keeping the community together. I would have also had to see a lower cost of waiting for this rebuilding subsidy. So I would have had to see in the data much more temporary migration. So these things would have led to a higher than 74 cents per dollar spent number. briefly, I think I'm almost out of time. Let me talk about migration costs. Here, I'm showing you in the baseline economy what the median consumption equivalent welfare loss is. In orange now, I'm showing you a world where I totally shut down migration to the mainland US. So this would be sort of if the hurricane had happened on a nearby Caribbean island where households don't have this relatively frictionless migration option. And in blue, I'm showing you what happens in an economy where migration costs are 25% cheaper. So you could think maybe this is what happened after Hurricane Katrina, where households could just get in a car and drive away. So in this low migration cost world, few households are locationally constrained after the shock. They can escape the immediate aftermath, and this is going to have lots of general equilibrium spillovers through rents and wages. If we're in the infinite cost world, people are stuck in the immediate aftermath. And so that also induces general equilibrium effects on wages and rents, so higher rents and lower wages. And so you can immediately see from this picture, if we have a policy that can move us from the gray bar towards the blue bar, that's going to be very powerful. So I'm going to find that a $750 migration subsidy in this model only induces less than an additional 1 percentage point of migration. It's mostly temporary migration, but it really shifts the housing demand curve in the immediate aftermath of the shock, lowering rents. And so the budget cost is only $60 per household, but it delivers very large benefits of roughly $1,000 per household at the time. Okay. Finally, if we do this unconditional cash transfer, unsurprisingly, we're giving lots of money in this world to homeowners who didn't have any property damage and renters. But somewhat surprisingly, I find that if you asked a homeowner, they know there's been this large hurricane, but they don't yet know what property damage they've personally experienced. They pick this large lump sum cash transfer instead of the in-kind rebuilding subsidy. So in general, I think this is building towards suggestive evidence that there might be large benefits from switching from indemnity type insurance to parametric insurance. So an insurance contract where payouts are conditioned on the aggregate rather than the individual shock. Lots of forces about this policy payouts, these rebuilding subsidies, are very similar to how current insurance contracts are structured. And so I think some of these findings apply to the private market as well as this government policy. So with that, let me just conclude. I showed you in this talk that homeowners with property damage really undervalue these rebuilding subsidies, that these welfare losses are large, even for renters and homeowners without direct damage, and that alternative policies can yield large welfare improvements at similar budget cost. Thank you.
Thanks very much. That was really, really terrific. And I'm sure all the people on here understand why it was that my colleagues on the price committee and I were so taken with your paper. And now, if you could stop sharing, we're going to switch over. Great, thank you. And I'm really pleased that Esteban Rossi-Hansberg has agreed to discuss the paper. I'm also thankful that he was helping us with the prize itself. Esteban is the Glenn A. Lloyd Distinguished Service Professor in the Department of Economics at the University of Chicago. He's been at a number of other places like Princeton and Stanford. But I guess with his moving to Chicago, he's gone home, which is where he got his PhD now more years ago than I will mention. He's also a research associate at the NBER and a research fellow at the CEPR, and he's the co-director of the International Economics and Economic Geography Initiative of the Becker Friedman Institute at Chicago. And he's an editor of the Journal of Political Economy. Esteban has a long and very distinguished record of research, and I won't go into all of it. He also has a long list of of awards. which I will not list um, because that's usually embarrassing. So let me just turn it over to you, Esteban, for some comments on the paper, and then please put your questions in the meantime either into the Q&A or into the chat. I can see them both, and we'll move on from there. So thanks again for agreeing to do this. Esteban, it's all yours.
Thank you, Steve. And well, first of all, it's a pleasure to discuss this paper. I know this paper, I've talked with Shifrah about it in the past when she was on the market. And so the first thing, I hope you can see my slides, is congratulations on the prize and on the great paper. I think it's a terrific contribution to the literature on the effects of shocks on local economies. And so I'm gonna keep my comments pretty kind of high level. I mean, I've discussed with Shifra some of the details in the past. But maybe for this audience, it's kind of more interesting to place the paper a little bit and think about why I think the paper is important. And so, there's local economies are hit by large and destructive shocks often. And this is partly the result of natural disasters, storms in particular, as in this case. And these are predicted to increase in frequency and size in the future due to climate change. So on the graph on the right, I have these graphs that comes from a paper that I have with Adrian Bilal, where we calculate the change in the annual probability of a storm, as defined by NOAA. And so you can see that in coastal areas in the U.S., that probability it's gonna or is predicted to increase by about 8%. For a 1 degree increase in temperatures, 1 degree Celsius increase in temperatures. So to the extent that this is happening, is going to happen more often, these storms are going to be larger, we need to understand what's the effect that they're going to have on these local economies and what's the type of destruction that they're going to create. And then, importantly, we need to, design policy responses that are effective in reducing the welfare impact of these storms. Now, these in general, understanding what these effects are is not trivial. Why? Because of course there's like a direct effect what the storm is going to destroy, but then perhaps the more interesting part is that there's many indirect effects through adaptation responses, equilibrium effects. Etc. And so, that's where Shifra's papers comes in. It takes this particular case and wants to, design kind of a model and use the model to then design policy responses that take into account these adaptation mechanisms. And so in particular, in this case, there's the temporary and permanent migration, there's rebuilding of infrastructure, there's rebuilding of homes and, financial actions that agents can take, including mortgage defaults. And so that's kind of very impressive to bring in all these kind of endogenous responses and think about kind of what this does. It all comes with a cost. So in one sense, it's great to study this particular case of Hurricane Maria in Puerto Rico because it was a large shock. I mean, Shifra did a great job in showing us kind of the magnitude of this shock for Puerto Rico. But it's one particular case in Puerto Rico, and so it's fair, I think, to ask okay, if I'm not particularly interested in Puerto Rico, maybe you should that. But if you are still not, would you care about reading this paper? I think the answer is definitely yes. But it does point to the fact that this is, in some sense, kind of a case study of this particular hurricane. And so, what can we learn from such a case study? Well, the first thing is that, this is about model design and policy design. And this model, of course, can be used for other circumstances that are similar in nature to what happened to Hurricane Maria. If we look at, we've done some work, this comes from the same paper that I showed in the other graph with Adrian Bilal, if we look at kind of the response of these local economies to storms, there's a strong income per capita response after. So these are like case studies here on the right. You see like a fairly large decrease in income per capita, and at the same time kind of this positive response in investments, which has also to do with these kind of policy responses that you see. So this is across many storms. And so the point is to say, well, this is a particular case where you see a particular policy response and kind of an effect on local incomes, etc. But when we look at the general response of these types of storms, there's kind of many similarities, and the general kind of responses that we see are kind of in line with some of what has happened there. That, of course, doesn't imply that there's no a lot of kind of special aspects of Puerto Rico and the particular hurricane that hit Puerto Rico in this case. So one particular thing that may be different than in other contexts, or maybe more important in this context than in other contexts, is this idea of the preference for being about your among your co-nationals and that or other Puerto Ricans, and that kind of plays kind of an important role. This kind of preference to be with their own, and kind of prevents them from migrating, and it kind of prevents them from migrating in the original equilibrium too. Right? I mean, even before you kind of need that, so not to empty out Puerto Rico and have them all come to the U.S. in the first place. And so this may be kind of important, kind of an important circumstance of Puerto Rico in particular. The other aspect that I think is kind of special is that these migration options, you can go to the U.S., but the U.S. is, there's not that many Puerto Ricans, as I already pointed out, but it's also kind of far away, and it's kind of a move that is in some sense much more aggressive than if you are in Louisiana and you're moving kind of to the neighboring county or the neighboring state, which we saw like big migration responses in those cases. And so, obviously these. And that, of course, is going to kind of change the distribution of economic activity in those places, which in turn is going to affect in this case, Louisiana. In Puerto Rico, there's kind of less of that because, the people are come to the U.S. and they're dispersed in the U.S. and in some sense that doesn't matter that much for the U.S. and it doesn't kind of feed back into effects in Puerto Rico. And the last thing that is kind of special, I mean, or still potentially special, I should say, it's not obvious that it's special, is this reconstruction supply constraints, which I actually find very interesting, and I think it's kind of important that the paper has it, that you get these shocks and then you want to rebuild, but of course rebuilding right away when the shock happened is very expensive, and so that holds you back from rebuilding. And obviously when you're in an island like Puerto Rico, the number of construction companies, etc., are going to be much more limited than if this shock happens in the mainland U.S. and you can bring in some of these construction workers to help out. To what extent does that happen? To what extent are there constraints to move construction companies across space, etc.? It's kind of an open question. And so this is interesting that is happening in Puerto Rico and is kind of relevant in Puerto Rico. It would be interesting to see, how relevant it is in other cases. And so I'll have a few more things to say. The first one is like, this unanticipated shock, right? I mean, so this is all predicated on, we didn't know that this would happen. We're in steady state, happily living in Puerto Rico, and then suddenly this terrible thing happens, and we all react to it. And it's clear that, why Shifrah does it this way, because, I mean, there's a technical aspect to this, which is, it's easier to study unanticipated shocks in these models. And so, I mean, it's, we are in the business of the feasible. So it's still, of course, interesting, but of course, there is anticipation, right? And in some sense, we want to eventually think about a context in which, people in Puerto Rico and people everywhere in the U.S. are understanding that, they have this risk, and that this risk is kind of ongoing, and that these hurricanes are going to come with some frequency, and that we design policy and that we design in some sense preparedness to take those probabilities into account, and that in some sense that can actually affect the type of policies and the type of reaction that we're gonna favor in the long run. And so in some sense, it's very interesting to think about like the effect of these MIT shocks and design policy. But when we design policy with full anticipation, taking into account, and the fact that people in turn are going to react to this policy by becoming less or worse prepared, the ultimate policy prescriptions may be different, right? And so we need to kind of be aware of this, that in some sense, yes, it's interesting. Yes, we did it because there's some sort of technical complications, but it can matter for the ultimate response. And kind of the key question here, I think, is really about rebuilding and incentives to rebuild and incentives in some way to, go back to a steady state that is, has good properties relative to just having people move and say, well, look, you're living in an area that is very risky, and so we're not going to really help you that much because I want you to ultimately move out of this area that is very risky. And so, in Puerto Rico it's tricky because it obviously has like some sort of national identity, etc. But that's certainly what we would probably want to do in parts of Louisiana and parts of Florida, right? I mean, where we do want people not to be there, rather than kind of help them rebuild whenever these shocks happen. And then the final point that I'll make is, there's an agenda here, which is, okay, so yes, these shocks happen in a particular region, and yes, we can think about, adaptation responses that are going to allow a particular location to deal with that shock. But in some sense, we also want to think about, well, these shocks are happening, they're happening with some frequency, and that's changing the whole distribution of the spatial economy, the distribution of the spatial distribution of economic activity, and that is going to lead to kind of a different type of equilibrium overall, right? So it's an equilibrium in which there's going to be, like we were saying, probably less people in Florida, less people in Puerto Rico, and maybe more people in Chicago. And so, or maybe not. And so, what are the consequences of this different kind of type of equilibrium? Now, of course, the issue here is that there's this trade-off that is, okay, so I can think about like these quantitative spatial models. That's kind of a lot of the work, for example, that I've done is kind of related to that. But to deal with those models, to be able to think about kind of those responses, kind of in general equilibrium across many locations, you're giving up a lot of the local spatial heterogeneity. And so so that's kind of where Shifrah's paper, I think, really excels, that it adds all that all that individual heterogeneity within Puerto Rico, which is, of course, important to think about mortgages, to think about housing decisions, etc. And so that's kind of the trade-off, right? The trade-off is, rich local heterogeneity of individuals vis-a-vis more anonymity at the local level, but more locations and the ability to think about that distribution of economic activity. Of course, what is the goal is to bring those two together, right, eventually. And the new frontier in some sense is, how can we make progress in adding the type of individual heterogeneity that Shifrah is doing to models with many locations, in which we can think about that evolution of how this kind of frequency of shock and distributions of shocks across locations affect the economy overall. But great paper, congratulations. I'll stop there now.
Thanks very much. That was terrific. A very rich discussion. And I've always been wondering about I've always wondered about certain aspects of insurance that are related to structures and housing because it never made sense to me that you paid people to build stuff right back where it was before, but there was never any mechanism for paying them for the land, so or to giving them land somewhere else. So I think that this is where this is related. It's also related to a literature which hopefully you don't know much about because I don't think it makes any sense about what people call insurance gaps. But anyway, thanks for very much for that and for those comments. I know that we have one question from Olympia if you'd like to ask, and then we'll turn to you, Shifra, and you can give responses. So please go ahead, Olympia.
Thanks a lot. Thanks for the super interesting paper and discussion. My question is actually related to these last comments that were made and has to do with insurance. So, I mean, it's just about whether you have any considerations on the role of insurance and like risk-based pricing of insurance. So I understand that the take-up is limited in the area that you're studying in your empirical setting, and that insurance may be comparable to state support in the post-disaster phase. So I read that. But I was wondering if you made any considerations on the role it could play in the ex-ante phase, so like as an ex-ante kind of way to manage exposure to disasters via risk pricing. So that's all. Thank you.
Thanks very much. Why don't we just go back to you, Shifra? We only have a few more minutes left. So if you have some responses or anything,
Yeah.
it's all over to you.
Yeah, thank you so much. Thank you for the fantastic discussion, Esteban. I think you've laid out the agenda for the field for the next 10 years. These are all sort of first order issues, some of which I've thought a little bit about and some of which I think remain for future papers. This anticipation question and thinking about sort of how are people thinking not only about risk in their own location, but risk in other locations, I think is super important, especially as we think about thinking about optimal policy design. In this setting, what I find so fascinating is that, right, so I can study where people where they went after they left, after this large shock. Where did they go? They went to places with other Puerto Ricans, which in this case meant a lot of people went to Florida. So they're sort of they're going somewhere where the shock hasn't been realized, but it has the same underlying distribution. And so in work, hopefully that we will have a draft in the new year. We sort of try to think about this mechanism exactly, that your social network might not help you hedge risk very well. And I think this is a big challenge for these models too, to think people need to have expectation, not just about the risk here, but also everywhere. On this insurance margin, I think, so I want to first stress that the features of the government policy are very similar to the features of private insurance contracts. So if you have a private insurance contract in the US for this type of shock, your payout is usually done through your lender. So you never see the cash directly. So the cash can only be used for rebuilding. And if you sell your house or default, so in the private market, the bank can keep the contract. So that feature is slightly different, but you, the household, can't keep the payout from the contract. So I think the fact that households have a low willingness, sort of this measure of household value, is in some way capturing their willingness to pay for this type of contract. So the fact that that's so much lower than the dollar payout tells, or at least I read that as saying that even if you had insurance in this market, very few households would be willing to buy this product without some sort of mandate. And per what Steve was saying, right, these contracts are really designed to protect, they're really designed to ensure your equity in the house and not, or sorry, the bank's equity in the house and not your equity in the house. And so I think the model that I have here, it could be very interesting to sort of interact with a supply side model of sort of credit and insurance, to think about how the contracts we write influence who can live where in a world where risk is rising. Sort of, is there a better contract we could write that would both give people a signal about future risk, but also sort of deal with some affordability concerns that policymakers have.
That's great. Thank you. Thank you very much. We've run out of time. I mean, I should say it reminds me of like having grown up in Southern California where there are fires all the time and watching people in Malibu, California just watch their houses burn down and then rebuild them and then they 25 years later they burn down and they rebuild them again, also always in the same place. My house burned down in the last fire, but that's another story. So anyway, thank you all very much. We've come to the end of our hour. There will be another webinar run by the E-Access Forum Young Scholars webinar series on December 1st. And the speaker is going to be Owen Kay from the Federal Reserve Bank of Dallas, who is going to present a paper on pollution taxes and clean subsidies in an open economy. So with that, thank you all very much, and we appreciate the support for the forum, and we hope that you continue to participate. And thanks especially to Shifrah and to Esteban for your presentations. Bye-bye.